I remember the exact moment I realized I had been lied to. I was sitting at my kitchen table, 34 years old, staring at two pieces of paper. One was a mortgage statement for a rental property I had bought 3 years earlier. The other was a brokerage account statement showing the stocks I had purchased around the same time. I had put roughly the same amount of money into both. And the difference between what those two papers were telling me, that difference changed everything. I thought I knew about building wealth. Nobody had ever sat me down and shown me the real math. Not my parents, not my school, not the bank that happily gave me a mortgage, not the financial advisor who collected his fee and smiled and told me real estate was the safest investment I could ever make. Nobody showed me the actual numbers side by side, and I am willing to bet nobody has shown you either. So today I am going to do something most financial channels are afraid to do. I am going to put both investments in the same room, run the same dollars through both of them, and let the math speak for itself. No agenda, no sponsor telling me what to say. Just the real calculation that will determine whether you retire rich or whether you spend the next 30 years working for someone else. Because here is what I know now that I did not know then. One of these two paths, real estate or stocks, has a dramatically higher probability of turning an ordinary person into a millionaire. And the one most people choose is not the one the numbers actually support. Let me take you back to the beginning. Imagine you are 25 years old. You have saved $20,000. It took you 3 years to save that money. You worked overtime, you skipped vacations, you drove an old car, you have $20,000 and one question: what do I do with this? Option 1. You put that $20,000 into an index fund tracking the S&P 500. You set up an automatic contribution of $500 a month. You do not touch it. You do not panic when the market drops. You do not celebrate when it surges. You just let it sit there and compound. Option 2. You use that $20,000 as a down payment on a rental property. You find a house worth $100,000. You take out an $80,000 mortgage. You rent the property out. You collect rent every month. You build equity. You own a physical asset you can see and touch and drive past on a Sunday afternoon. Both of these sound reasonable. Both of these sound like something a smart person would do. So which one makes you a millionaire? Let us run the numbers on the stock market first. The S&P 500 has returned an average of approximately 10% per year over the last century. Not every year. Some years it loses 30%. Some years it gains 40%. But averaged out over long periods of time, the number is consistently around 10%. That is the single most important number in this entire video. You invest your $20,000 at age 25, you add $500 every single month, you earn 10% per year on average, you do absolutely nothing else. By age 35, 10 years, in your account is worth approximately $140,000. You contributed $80,000 of that yourself. The market gave you $60,000 for free. By age 45, 20 years, in your account is worth approximately $410,000. You contributed $160,000. The market added $250,000. By age 55, 30 years, in your account is sitting at approximately $1,050,000. You are a millionaire. You contributed $240,000 of your own money over 30 years, and the stock market turned it into over $1 million. Let that land for a moment. You did not flip a house. You did not find a hot stock tip. You did not take on massive debt. You did not get lucky. You simply put money into an index fund every single month for 30 years and let compounding do the work that most people spend their entire lives trying to do manually. Now let us run the same math on real estate. You buy that $100,000 house at 25 with your $20,000 down payment. Your mortgage is $80,000 at a 6% interest rate over 30 years. Your monthly mortgage payment is approximately $480. You rent the house out for $1,000 a month. On paper, that looks incredible. You are making $520 a month in profit, right? Wrong. Here is what nobody tells you when you are standing in that house imagining the rental income: property taxes. On a $100,000 house, you are paying roughly $1,200 a year. That is $100 a month gone. Insurance, another $70 to $100 a month. Maintenance and repairs. Every real estate professional will tell you to budget 1% of the property value per year for maintenance. That is $1,000 a year, $83 a month, and that is in a good year. The year the roof needs replacing or the furnace dies or the tenant floods the bathroom, that number explodes. Vacancy, properties do not stay rented 100% of the time. Industry average is about 8% vacancy per year. That is roughly 1 month every year where you collect zero rent but still pay the mortgage. Property management. If you hire someone to manage the property, and most landlords eventually do that, is 8 to 10% of monthly rent. Another $80 to $100 a month. When you add all of that up, your $520 monthly profit has become something between $0 and $100 on a good month. In many cases, in the first few years, you are actually losing money every month and covering the difference out of your own pocket. But you are building equity. That is the argument every real estate investor will make at this point. You are building equity, the house is appreciating, you own something real. So let us follow that all the way to the end. Average home appreciation in the United States over the long term is approximately 3 to 4% per year, not 10%. 3 to 4. Some markets beat that. Many markets fall below it. The national long-term average is right around 3.5%. Your $100,000 house at 3.5% appreciation per year is worth approximately $280,000 after 30 years. You now own it outright because the mortgage is paid off. That is real wealth. That is a real asset. But here is where the comparison gets brutal. Your stock portfolio after 30 years is worth over $1 million. Your property after 30 years is worth $280,000. The stock investor has 3.5 times more wealth. And we have not even accounted for the tax advantages of index fund investing. We have not accounted for the liquidity difference, the fact that you can sell $10,000 of your stock portfolio in 60 seconds, but selling a house takes 60 to 90 days and costs you 5 to 6% in agent commissions. We have not accounted for the stress difference, the 3 a.m. phone calls when a pipe bursts, the eviction proceedings that cost thousands and take months, the tenant who stops paying rent and dares you to remove them. Now, I know what the real estate investors are thinking right now. They are thinking, but you can leverage real estate. You can use the bank's money to amplify your returns. That is the real power of property. And they are right. Leverage is real. It is one of real estate's genuine advantages. When you buy a $100,000 house with $20,000 down and it appreciates to $140,000, you have not made 40% on your money. You have made 200% because you only put $20,000 in. That is leverage working in your favor. But leverage is a weapon that cuts both ways. When that same house drops in value, and houses do drop in value, ask anyone who bought in 2007, your $20,000 equity can be wiped out completely while you still owe $80,000 to the bank. You can end up owing more than the asset is worth. Stocks bought with your own money cannot do that to you. Your stock portfolio can drop 50% in a crash and you still own every single share. You have not lost anything until you sell. And if you wait, history shows the market always recovers. I am not here to tell you real estate is bad. It is not. Real estate has made millions of people wealthy. There are specific strategies, house hacking, commercial real estate, short-term rentals, real estate investment trusts that can dramatically improve those returns. And there are markets and time periods where property has massively outperformed the stock market. But I am here to tell you something that the real estate industry, the mortgage industry, and the entire ecosystem of people who profit from you buying property do not want you to internalize. For most people, for ordinary people without insider market knowledge or the time to become professional landlords or the capital to build a real portfolio of properties, the stock market, specifically low-cost index funds, is a more reliable, more accessible, less stressful, and mathematically more powerful path to becoming a millionaire.